We can't stop aging, but we can take advantage of being older. Coming up on today's show, some perks for reaching 50 and beyond, and retirement roadblocks to avoid. It all starts right now on Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts, Mark Stimson and Casey Elkins. You can find him at Elevated Financial Management right here in Seattle. 42 years combined experience between these two in the retirement planning business. It's always about helping their clients get ready for their retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate, and each and every week we hit the topics. Each and every week we get into these discussions, and you're going to have questions about your own retirement situation. Well, we have an opportunity for you. We have 10 appointments. We're going to open those up during the course of this radio show, and they are complimentary. That means no cost, no obligation, no pressure. See where you are in your planning process. Maybe you haven't started. Maybe you're in the middle of something. Need a second opinion. Stay tuned. We'll tell you about those appointments as we move through. So once you turn 50, and especially after the age of 65, you can qualify for extra tax breaks. And the older people are getting, the bigger the standard deduction, and they can earn more before they have to file a tax return at all. So here are some ways to save a little money on taxes as you get finer with age. You age a little bit. So, Mark, let's start with you, and you got a number of these. The first one we'll go with is bigger standard deduction.
Yeah, I think everybody's really going to love this segment of the show this week because, as we know, taxes are a hot button for most of us right now. And we're going to spend some time talking about that. So you just mentioned, Morgan, a bigger standard deduction. So if you're not able to itemize, there are still some things that you can do. So you can claim a larger standard deduction if you or your spouse is 65 or older. So notice that point. If you or your spouse is 65 or older, you're going to get to use a bigger standard deduction. And that deduction for older taxpayers is going to be $1,850 higher than the deduction for people that are under age 65. So you get close to a $1,900 higher deduction if you're over age 65. Now, that brings us to a question that a lot of us, people that come into our office, students and prospective clients, they're saying, well, Mark, is there an age where I might be able to stop completely filing taxes? I think a lot of us would love that to be the answer. And there is. We're going to talk about one where that can happen. But for most of us, taxes, we just want you to understand, are not going to be determined by your age. So you're never going to age out in paying taxes. I wish we could, but for most of us, that's never going to happen. So here's the rule. So basically, if you're 65 or older, you're going to have to file a tax return for 2022. Here's the number, your gross income is $14,700 or higher. Now, if you're married filing jointly and both are 65 or older, that amount is $28,700. So remember, it's $14,700 if you file single, and if you're married, you basically double that to $28,700. Now, if you're married and you file jointly and only one of you is age 65, that amount is going to be $27,300. Don't ask me to try and explain why that number is that much lower, but that's the number if one of you are 65, but you file jointly. $27,300. So that said, there is one situation in which you'll be able to kiss taxes completely goodbye. Here's what has to happen. If your only source of income is Social Security, you won't owe taxes, and you're probably not going to need to file a tax return. But if you want to look that up, you're going to go to the IRS publication 501, okay, and look at the details. That's IRS publication 501 to see if you may not need to file a tax return at all. Now, what about maybe an additional IRA deduction? Well, workers age 50 and older get to contribute an additional $1,000 to an IRA, or a total of $7,000 in 2024. So you get it, what we call a catch-up provision. right, Case? And that's going to bring us up to what about catch-up provisions when it comes to a 401k plan? What can they do there?
Well, that the whole point here is those that are over the age of 50, and realistically, the reason we're talking about that is because we're talking about those that are planning for retirement, right? And so, if you're over the age of 50, you have a higher contribution limit into your 401k, which is definitely something you want to take advantage of. If you're under the age of 50, you can put in $22,500, but for the year. But over the age of 50, you can add an additional $7,500. So you could put $30,000 into your 401k. And the reality is this, right, Mark? I mean, if you're 50, let's say you got 10, 15 years before you're going to retire. If you can put $30,000 away each year, if your income lets you do that,
that'd be huge.
That's massive, right? I mean, just on contributions alone, let's say it's a 15-year time frame. You got $450,000 that you could put away. That doesn't include any growth. And so, in your 50s should be your highest earning years.
Right.
And so that being the case, you really want to take advantage of that. We talk about this a lot. I've said it again. I've said it over and over again. The idea is that timing the market is going to be an issue. Time in the market is what's going to help you to win, right? That's it, because there's going to be good years, there's going to be bad years, but we need an overall time frame, and so 15 years could help accomplish that, where if we're contributing over that time frame, our chances of success are much higher because we've got time in the market. So those catch-up provisions, that catch-up contribution is really important and something that we definitely don't want to miss out on.
Guys, want to jump in and just say, look, tax is going to be very, very important to you, at least to plan for them as you move towards retirement. It would be a great idea to not pay taxes, but the majority of us are going to be taxes all the way, paying taxes all the way through retirement. So just be aware of it. You got to plan for these things. An opportunity to get on the calendar with Elevated Financial Management ongoing during the course of this show. Again, these are complimentary appointments. We're going to tell you more about them here in just a second, but get in line and grab an appointment. 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Again, 866-668-3625. All right, Casey, we got two more we want to get to. Early withdrawal penalty. Talk a little bit about that because that kind of goes away. And then the higher HSA contribution limit.
Yeah, so that early withdrawal penalty, that's something that many folks are probably unfamiliar with as it pertains to their 401k and things of that nature. So I think most are aware of the idea that if you have money in your 401k or your IRA or 403b, those qualified accounts, tax deferred type accounts, if you want to take money out before the age of 59 and a half, that's that's going to cause a penalty to you, a 10% penalty. So you can access the funds, but there's a 10% penalty for accessing those funds during that time frame. So that's something to be aware of. That's not a problem most of the time. As long as we're saving in other accounts and we've got checking and savings and good income, that typically doesn't become an issue. Once you've reached age 59 and a half, now you have the ability to start pulling funds out without a penalty. And that's really important because realistically at that time you're getting closer to retirement, and it may become important to now possibly subsidize your income. Maybe you're going to take a step back from work and start working part-time, so we need to start taking money out of our retirement accounts to live on. But in addition to that, it also allows you the ability to invest differently outside of those accounts. If you've got the majority of your funds in a 401k, and you can now over the age of 59 and a half, and you have what's called an in-service withdrawal provision, which means that even while you're still working at your current employer, you can start to take funds out. You now have more control and you can invest those funds in a different way. So it's situational as to whether or not that's the best thing for you, but definitely something to consider. And realistically, again, just giving you more control, giving you the ability to invest as to what's appropriate in your circumstance. And that brings us to our last one, which is higher HSA contribution limits. So that's really important, right, Mark?
Yeah. In fact, one caveat to what Casey was just talking about. There are a couple of hardship provisions that if you are dealing with certain, maybe really tough situations in your financial life, buying a home, first time, serious medical situation, there are some provisions where you can get around that 10% penalties. So
That's
just
true.
keep that in mind. Now, the higher HSA, all I want to say there is it's one of the best tax advantage things that we can do each and every year. So I highly recommend that if you have the ability and you have a high deductible health plan, put as much into your HSA plan as you possibly can. The limits for 2024 are going to be $4,150 for a single person. And if it's family coverage, you can go up to $8,300. So please, that money will come out tax-free, and it's a wonderful tool. So max out your HSA if you have the ability and are on a high deductible health plan.
All right, gentlemen, let's help some people out. We've got the 10 appointments with Elevated Financial Management. They're complimentary. Walk us through what's going to happen for these 10 callers.
If you've noticed anything that we've been talking about, you're kind of really concerned about taxes. Maybe you worked at Boeing, you've saved at least $250,000 or more. These plans and this help is really going to be beneficial for you. So please, we have a whole team of certified financial planners that's going to put together a written plan for you. We're going to take a very hard look at your tax situation. Are you maximizing that? Have you maximized your Social Security that you have worked a whole lifetime to build up? Are you going to get the most out of that? And then what about, is your guaranteed income going to last a lifetime, which could be 20, 30 years or longer? So please, if any of these things are causing a little bit of concern or questions, pick up the phone and give us a call, because we really want to help.
All right, the number to call to grab one of these appointments, 866-668-3625. That's 866-668-3625. If you've saved $250,000 towards your retirement or more, these strategies are going to work best for you. 866-668-3625. We often talk about the roadmap getting you to retirement. No matter what road you choose, you're bound to run into some roadblocks and maybe a detour here and there. When we come back, we'll find out, well, how you get the right detours and get on the right road. Welcome back into Elevate Your Wealth. Your hosts are Mark Stimson and Casey Elkins. You can find them right here in Seattle at Elevated Financial Management. Check them out online. It's a great resource website for you. EFMNW.com. All letters. EFMNW.com. Again, TV show links are there for you, Elevate Your Wealth, and all of our radio shows in podcast form, so you can listen, you can watch, and you can learn more about retirement planning. And again, contact information. If you have any questions, get in touch with Elevated Financial Management, get those questions answered. And again, 42 years combined experience for Mark and Casey, helping hundreds of their clients get ready for just that, their retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate. So once you turn, well, you know, the dial and you're headed towards retirement, have you ever been driving, you know, and we've all gotten behind the wheel and you're going someplace and you've never been there before. You're relying on that GPS, all right? Just like Michael Scott did in a classic sitcom, the American version of The Office.
Proceed straight. Make a right turn.
Wait. No. It means bear right.
No,
Up there.
It said right. It said take a right.
No, look. It means go up to the right, bear right, over the bridge, and hook up with 307.
Make a right
Maybe it's
turn.
a shortcut, Dwight. It said go to the right.
It can't mean that. There's a lake there.
I think
it knows where it is going.
This is
the machine knows.
This is the lake.
Stop yelling at me.
No, it's up here. There's no road here.
It's great until it isn't. And that's kind of what happens if you keep your retirement plan on autopilot. We talk about this quite often, and there could be a new or a better way to get there, but unless you actively monitor things, say update your GPS, you could end up where you don't want to be. So, I mean, we get a chuckle out of that clip, but it's very, very true when you think about it. We're going to go over some roadblocks, and let's just talk about it. Roadblock number one. Casey, you're up first.
Yeah, I think this is something that many people find themselves in this situation right now. They're paralyzed by inflation, volatility in the markets, and they're overwhelmed, right? I mean, we see it on clients' faces all the time. And we talk about it a lot in the office here. because that analysis, I guess, leads to paralysis, right? You're concerned about what's going on. You don't know what to do. You don't know how to act for a given situation, like Michael Scott there. And so you kind of just leave it on autopilot. You're just following that direction, that path that you're already on. And for those that are unaware, Michael Scott drove right into a lake because that's where the GPS told him to go. And something equivalent to that is happening for folks that are approaching retirement right now. They're on autopilot. They have their investments that they set up when they were 40 or 45 or 50, and they haven't reviewed them recently. Nothing has been changed. Their GPS hasn't been updated, right? So the reality is that they're heading down a path that's going to drive them into the lake at some point, right? It's not going to turn out the way that we want it to because we're not keeping up with the changes. And ultimately, even if the investing world wasn't changing over the last 10 or 15 years, your life is changing. So even if the investing world was static, your life has changed. You're now approaching retirement. And so the changes that you need to make are due to the fact that your life has been changing. You need to make adjustments accordingly and shift, right? And that's really what it is. So people feel like they have whiplash from the ups and downs in the market, feel powerless. And we get that, right? We understand that feeling and we see it a lot, as I mentioned. So the solution really is to control what you can control. You've got to grab the bull by the horns. That means potentially talking with somebody who can help guide you and show you some new investments and talk to you about how you're currently invested, help you understand that, and then start talking about solutions to make those changes. That means looking for a roadmap for retirement, a written financial plan that's going to guide you down that path, take care of you over time, and give you the confidence, the clarity, the independence to do what you want to do. But it requires action on your part to do so. We can't bury our heads in the sand and hope for the best. Things are changing around us. Our lives are changing. And so this is something that you've got to prepare for. In addition to that, your retirement's going to last for years. That means that the market volatility that we're experiencing now, you're likely going to experience it again in the future. We've had market volatility before, 2008, 2000, number of times before that. I mean, that volatility is not new, but if you're approaching retirement, it's definitely uncomfortable, right? So now is the time to do something about it. So that brings us to retirement roadblock number 2, lacking the retirement mindset, Mark.
Yeah, this is a huge one for everybody that's listening today. You've got to recognize that your retirement is more than simply a collection of improperly coordinated investment accounts you have amassed over time. There's so much more to it. I have a great article from Forbes magazine that uses the Wizard of Oz as a correlation or an illustration of this point. The distribution advisor is totally different than the accumulation. And they liken it when the Wizard of Oz went from just being a black and white movie to a color movie. And boy, those of us that maybe were born in the 50s or 60s, we remember that movie very much. And when it went to color, boy, that was one of the coolest things ever for a movie that we all had grown up with. So you need to find a distribution advisor, one that specializes in helping us come down the mountain. Because if you only talk to your accumulation advisor, even if you have a 30-year-long relationship, just ask that advisor about taxes and see what he says. Right? He'll tell you to go see your accountant or your CPA. We don't do that here. We're going to address tax. We're going to help you plan for what's the best way to deal with taxes in every scenario that you're going to face in retirement, because you're coming in to the phase now of preservation and distribution. It's totally different than accumulation, but however, as a result of your wealth accumulation, the timing of your Social Security benefits are going to come into play. What choice are you going to make when it comes to your pension? Are you going to take a life-only option, or are you going to take a 50% spousal, 100? There are even some options where it's life plus what we call a period certain, life plus maybe 10 years. There's a lot of options that you need to understand the pros and the cons of each one before you pull the trigger. Because once you pull that trigger, you can't put the bullet back in the barrel. It's not going to happen, right? So what's the solution? Casey mentioned it. You have got to have a solid retirement plan And it's not just about managing finances. There's going to be talk and help about how do I reduce my taxes? What do I choose when it comes to my health care provider? Do I go Med Advantage or Med Supplement? What about any legacy planning? Do you have a trust? Or are you going to use a will? What about medical directives, powers of attorneys? All of these things are the things that you're going to have to make decisions on that can be monumental, and you don't want to mess them up. So please think about that and give us a call, because the markets are going to be, like Casey said, we're going to have volatility, but with a plan, we can find ways to deal with this.
So how's your retirement GPS doing? Do you need to update it? A lot of people out there are scratching their heads going, yeah, probably do. Well, we've got appointments available with Elevated Financial Management. They're complimentary. We have 10 of them for our radio listeners. All you got to do is call 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies going to work best for you. 866-668-3625. Got another roadblock. Casey, we'll throw this one at you. You're just not sure how or where to begin.
Yeah, the best day to start is yesterday.
Yeah.
Right? I think that's the case. Yeah. So many people feel that, right? Again, analysis or paralysis by analysis, right? I think people are overwhelmed, not sure where to start. There's so many things going on in our lives. We're so busy. And it's something that, most people feel intimidated by finances in the first place, not just their own finances, but just finance as a general topic seems to be overwhelming for many folks. And we get that. It's complicated, right? I mean, we understand that this is what we do every day. And so the point here is that really you've got to get started. You've got to start figuring out what you want your retirement to look like, what you can save for retirement. If you feel like you're behind, and now's the time to audit that and figure out how much more you can contribute, and really take advantage of that to the full, to make sure that you're planning to have a successful retirement. So there's no time like the present. You don't want to hesitate and look back and wish that you'd saved more. You will never look back and wish that you had saved less when it comes to retirement. That is what's going to give you the confidence to do what you like to do. And so that being said, realistically, we talk about this all the time. We like to help folks get a written financial plan put together by our team of certified financial planners. So for those listening at home, if you've saved $250,000 or more, please don't hesitate to give us a call. If you feel like your GPS is on autopilot, if you feel like you're heading down the same path you were heading down when you set up your 401k 10 years ago, or you haven't reviewed your investments and you're approaching retirement, now is the time to take advantage, to have that conversation and start to figure out what all this is going to look like when you retire. So that includes talking about taxes. What are you going to pay in taxes, and what can we do to lessen that number? How are you invested? Are you invested appropriately, not only for your age, but for your comfortability? Are you set up in a way that you're insulated from the markets to some extent to make sure that that money is there for you? You worked hard for it. You want to make sure it works hard for you, but you also have got to make sure that it continues on. So if you want that, please don't hesitate to give us a call. Again, a written financial plan put together by our team of certified financial planners.
All right, 10 appointments. And again, they are complimentary. 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. 866-668-3625. 10 spots. They will not last long. 866-668-3625. When we come back on Elevate Your Wealth, we have one more roadblock to discuss, and then we're going to talk all about your 401k and how it works, and you'll probably be shocked. A lot of us are clueless. We're just throwing money in it. We'll talk about it when we come back. Welcome back into Elevate Your Wealth, hosted by Mark Stimson and Casey Elkins, powered by Elevated Financial Management right here in Seattle. 42 years combined experience between these two, helping hundreds of their clients get ready for retirement. They're certified financial fiduciaries. I'm Morgan Patrick, consumer advocate. We've been talking about roadblocks to avoid. Make sure your retirement GPS is updated. So again, paralyzed by inflation, volatility. I mean, all the information that's out there. Just make sure you're advised well and you're planning well. The lack of that retirement mindset we've talked about. And also, you're just not sure where to begin, how to get going, how to start. Well, folks, now we get to roadblock number 4. Mark, here it is. I'm going to throw it on your plate. You just struggle to understand the different advisory services and options that are out there.
Yeah, this is a good one to understand that not all platforms and advisors are created equal. I think, yeah, exactly. Really? But really, the bottom line is you need to find someone, as we talk about, that really is going to help us with the distribution phase of a lifetime worth of savings and a plethora of choices that will affect you for maybe 20 to 30, 35 years. It's important that you find an advisor that is skilled with that set of things that he's going to need to help bring you down the mountain. So we know they're not created all equal, right? Some platforms are going to be dedicated to those who want to just self-manage. I mean, they could be good with, we heard the term, it's popular today, a robo-advisor. That may be all that you need. If you use a robo-advisor, the fees are going to be very low, but you're not going to get any personalized help. We're not big fans of robo-advisors in our world, what's important to us, because there are so many things that we have to talk about that are really emotions get involved, and you're not going to be able to do that with a robot. It's really that simple. Where do you want to live? I just had a great one the other day. They have 3 children, 2 boys and a girl. The girl lives with them in a nice house on a lake. The girl wants the house. Mom thinks it would not be fair to give the daughter the house. So what is she going to do to keep it fair? And so these are all things that we have to deal with when it comes to a total holistic retirement plan. And we believe that's what you deserve. So some of them can be low cost when it comes to your investments. If you're going to, again, be a do-it-yourselfer, then there's going to be those that are going to want professional help, and they're going to pay a fee that's going to be used to help them on their investment portfolios and what they want to do there. But the point is, you get what you pay for. I think Casey and I, we've seen this time and again. Even with some of the big wirehouses, people are not getting the advice and the help that they deserve, and they're paying still a pretty good fee for that. So what is the solution? You need to start working with a planning-centered advisor. They're going to concentrate the efforts in a few very specific ways. We're going to help to develop a plan for you. We're going to continually advise you how to make adjustments to that. We're going to then talk about different strategies that you're going to want to employ that are going to do different things. Casey and I, one of our primary goals is to ask client, what specifically do you want this section or this bucket of your money to do? We're not going to sell you anything. We've just got certain tools that are going to be used to help you accomplish that financial goal or that financial strategy. It takes certain vehicles to do that. Then we may need to talk about estate planning a little bit. What type of a will, or do you have a trust? What about your powers of attorney, your medical directives? These are all things that need to be talked about. And boy, they can evoke some emotions, especially if you've ever helped your parents or grandparents or any of them maybe went into a long-term care situation. What do you have going in that regard? What about tax preparation and tax planning? What are you doing there? And then again, retirement income planning. So here's what you have to do. You have got to make sure that you concentrate on managing what you can control, right? There's a lot of things, including the market, that you can't control. You might think that you can. You might try and time it, but how's that work out for everybody, Casey?
Not so great.
Not so great, right? So there's going to be obstacles that are going to come up. But if you work with an advisor that has a fiduciary responsibility to always keep your concerns and goals first, they're going to help you build that comprehensive and holistic plan that each and every one of you listening today deserve.
Yeah, and you avoid the roadblocks. That's what we've been talking about today.
Yep.
The opportunity to talk about it. See if you've got some roadblocks in your path you're not aware of. It's going on right now. We have 10 appointments. They are complimentary. If you've saved $250,000 towards your retirement or more, these strategies are going to work best for you. Call the number now and pick up one of these appointments. 866-668-3625. Again, maybe we'll discover a few roadblocks in there. 866-668-3625. But better yet, come up with a plan to avoid those roadblocks when it comes to your retirement. All right, guys, let's switch gears. Let's head to that 401k. It is a huge vehicle for so many of us when it comes to retirement. But do you really know how it all works? That's a great question because so many people are like, oh, yeah, I've got a 401k. Well, what does that mean? So the first couple I'm going to throw at Casey. Casey, how much should I be contributing to a 401k and what should I invest in?
Well, how much to contribute? I think that's probably the biggest question I think folks ask, right? Is how much should I contribute? Because the reality is this: is if you work 40 years and you contribute to a 401k over that time frame, you've been working however many years, like I said, 40, and in that circumstance, now you've reached retirement. You don't really want your standard of living to drop, right? I mean, you've established a certain standard of living, things that you want to do, and so a lot of times people are thinking that they're going to need to spend less money in retirement. You may need to spend the same amount or maybe even more because now you got more free time to go do the things you want to do. And so to answer that question is actually maybe a little simpler than you might think. Numerous studies have shown that American workers should be adding at least 15% to their 401k accounts each year. So 15% of your income to your 401k accounts. Now, those that do that typically can expect to build balances, account balances that allow them to not reduce their standard of living when they retire. Yeah. Pending, of course, that it's invested the right way and that they're setting things up properly. There's some other details there that get left out of that kind of singular statement. But the idea is that if you save 15%, you do that over a time frame, you're going to be able to be successful in how much income you can pull from retirement. Then that brings us to that second point, right, Morgan, of how much should I invest? And so, most 401k, nearly all 401k plan provide participants with at least one option to obtain investment advice at no cost. So most folks have some ability to get investment advice at no cost. But in reality, you're going to want to try and figure out those investments inside the plan that are best suited to you. And so working with an advisor, actually talking with somebody is very valuable. Mark mentioned robo-advisors. If you feel like you can do it yourself to some extent and use a robo-advisor, that's okay. But most people want a more personal touch and want to have that type of input so that they know they're going down the right path and can bounce ideas and questions off of somebody who has more knowledge in that space than they do.
So important, folks, just to be aware. I mean, just the 401k. And these are questions, again, along with some answers. You can jot these down. There's going to be an opportunity to get on the calendar with Elevated Financial Management. You'll meet with Mark, Casey, their team, and talk about your situation. If you've got 401k questions, certainly bring those along. So we've talked about how much should I contribute to the 401k? What should I be investing in the 401k? Now, Mark, the next two are to you. What type of contributions, traditional pre-tax, maybe a Roth, should I be making? And how do I know if I'm on track?
Now, these are really important. Casey and I are both big believers in the Roth contribution. You may not like it so much at the beginning because you don't get that deduction, but we promise you that in the long run, you're going to love that you did it this way. So please consider that Roth very heavily because all the money on the back end when you need it in retirement will be tax-free. There is one of the proposals now for some tax changes is that they might even try to eliminate the Roth concept. And if they do that, I think that's going to be a travesty because the Roth, I believe in most cases, not all, but most, is a better way to go than the traditional IRA. Now, if all you need is deductions, well, you might want to consider a traditional 401k or a traditional IRA. But in the long run, the Roth will give you tax-free benefits that a traditional plan will never be able to do. So again, how do I know if I'm on track, right? Well, we know that virtually all 401k plans have some sort of feedback system that's going to be attached to them. It's going to help those that are willing to go into their plan and look at it a little bit to see exactly how they're doing. So again, you've got to be a little bit proactive here. There are some people, they never open their 401k plans. They never want to look at it. And if you're one of those, we might say you might want to change that thinking just a little bit, because there are rebalancing things that you can do. There are investments sometimes being added each year. So please don't stick your head in the sand and think that your 401k should be on automatic pilot. We know that is absolutely not the case. Some plans have more conservative investment than others. So you really need to understand your plan, which brings me to a quick story that I think Casey could share in just a couple seconds here, of a plan administrator and what she told us at our work event that we both couldn't believe. What was that, Casey?
Yeah, we were blown away by this. We talk about 401ks when we teach workshops and things of that nature, and the different investment choices, and how most people just feel like they don't understand their options and they don't feel educated about them or empowered to make their own decisions. And she came up to me after our workshop and thanked us for the presentation, and then ultimately said, I'm the plan administrator for our plan at work, and I don't feel comfortable with it. I don't understand it. I don't feel empowered to make decisions.
Yeah.
I mean, that is very, very telling. I'm blown away she was even willing to share that with me.
Yeah.
But more than that, I'm blown away that that's how she feels being the position that she's in. And I think ultimately that's how so many employees feel, right? If she feels that way, how many more employees feel that way and just feel like they don't get it? And it's a big problem.
Well, and how many administrators out there you bring up, and maybe you kind of uncovered the tip of the iceberg. How many administrators out there really know?
Exactly.
With all these different companies. So, I mean, you need to be in touch with this. Mark, we have a limited number of spots. We've got 10 appointments. Walk us through what's going to happen for these 10 lucky callers.
Okay, so if you've been listening today, we just talked a lot about your 401k plan. Maybe you haven't looked at it like you would like to have over the years. Give us a call, because what we want to do is we'll look at the plan with you, maybe look at different choices that you'll have that you can make inside your plan. So if you've maybe worked at Boeing or you've saved at least $250,000 or more, pick up the phone. Let our team of certified financial planners put together a written plan specifically for you and your unique situation. How's your income? Is it guaranteed? Is it going to last 30, 40 years possibly? What about the taxes? Are you going to be able to minimize those by doing some advanced planning? Social Security, that's another big one. People are rushing to start Social Security at age 62. We would tell you, for most people, that is a big mistake if you decide to do that. What about some estate planning? How do you want your assets to move to your children? All of this and so much more can be taken care of if you'll just let us look at your situation.
Phone number to call to grab one of the 10 appointments, 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Again, if you've got questions, you can get answers right now. 866-668-3625. When we come back, it's time for Retirement Scenarios. Back into Elevate Your Wealth. Your host, Mark Stimson, Casey Elkins. Elevated Financial Management, where you can find them right here in Seattle. Check them out online. It is a wonderful resource website, efmnw.com. All letters, efmnw.com. Links to the TV show, Elevate Your Wealth, and, of course, radio shows and podcast form for you. 42 years combined experience for Mark and Casey in this business, and it's all about retirement planning, getting you ready for your retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate, and we are on to our scenarios. Casey, you get the first one. Here it is. I'm 50 years old. I make $65,000 a year, and my company doesn't offer a 401k plan, but I recently opened a Roth IRA with a contribution of 10% of my paycheck. Is this a good investment for me? How much can I expect to make, say, in 10 years when I'm planning to retire?
Well, I'll say this. I don't think you'll ever regret putting money into a future tax-free account, right? So to say, yes, it's a good investment, I feel real confident about that, right? In the sense that you're paying taxes at today's rate. We talk about this a lot. right now we're in a tax window that we will likely never see again. You have doors or windows open to you that you likely will not have in the future. And so choosing to pay taxes at today's rate when we're all under the belief, and I think a very good, confident belief that taxes will go up in the future. So paying them today so we don't have to pay them tomorrow, that is a great way to go about it. A Roth IRA is definitely a good option for you. And I do believe a great investment choice as far as taxes are concerned. Now, the second piece to this is how much could I expect to take out of that account when I retire? Well, there's some other things to consider here. One, hopefully that's not your only source of income, and that there's some other accounts as well. Saving 10% of a paycheck is great, but we're going to need some other income sources as well. Likely Social Security will be in that mix too. But ultimately, we want to have some other income. And so how much we could expect to take as income from that account, that's really hard for me to say, right, when we're looking at this, because how the money's invested is going to have an impact as to how much income you could take in the future, what the market returns over the next 10 years. I mean, there's a lot of variables and unknowability in that question. But I will say this. The Roth itself is a great tool and a great investment from a tax perspective. How the money is invested in the Roth is a different subject or a different topic. That in and of itself is equally as important. We can put lots of money into a Roth account that's not going to be taxed in the future, but if it's invested poorly and doesn't grow, then the tax benefit really doesn't mean anything. So there's two parts to that equation. There's two sides to that coin. And ultimately, you've got to be working with somebody that can help you set that up the right way. Just putting it in a Roth is a good start, but we've got to invest it appropriately beyond that and make sure that that is growing and in a way that's not taking too much risk that we're uncomfortable or setting ourselves up to too much market volatility. So we really want to make sure that we're being responsible with that. So that brings us to the second scenario. Mark, I'll give this one to you. My ex-husband and I were married 25 years before we divorced. He passed away this year. He was 68 and I am as well. My question is, how is Social Security affected? Will I still be entitled to half of his Social Security even though he passed away?
Now, this has got some very intriguing scenarios that you brought up here, Casey. I would need quite a bit more information to fully answer this, but I can start by saying you have been married long enough. The standard rule when we get divorced, you have to be married for at least 10 years. So you've met that requirement very, very easily. Now, when it comes to a spousal benefit, that you definitely will, that's something you're going to be able to take advantage of if you want to. I would need to see the numbers on your own individual work record before I could tell you if a spousal might make more sense. Because here's the bottom line. The spousal right is going to be based on your deceased husband's FRA amount, not when he started. Let's say he didn't start till he was 68 and then passed away. If his full retirement age is 66, even though he waited till 68, your spousal amount will be based on his 66 number, not his 68. So again, but that's totally different than a survivor benefit. A survivor benefit, you're going to get boosted up to the age. Let's say a person waits till 70. The husband waits till 70, passes away. The spouse is going to get a spousal boost when he passes away up to his 70 number. But that is not the case when it comes to a spousal. A spousal is only based on the full retirement age, not, let's say, age 70. So there's a lot of intricacies to Social Security planning that a lot of people don't realize. So the answer is it might be better for you to go on a spousal, but it might not. So again, that's why please find somebody that specializes in maximizing Social Security planning, and we'll be able to, we have some wonderful software that will figure that out for you. And it's actually pretty quick and easy to find out what's going to be the best route for you to go once we have all the information. That's the key to this whole thing. We need all the information to tell you what might be the best strategy for you.
I mean, so very important to have a plan. Everybody's situation is going to be different, so your plan has to be customized to you. You're not going to be doing the same thing as your neighbor or maybe a relative at the family reunion because your situation, again, is unique. So make sure you have that customized plan. We're going over retirement scenarios. You're going to have questions about your own situation. You can get on the calendar with Elevated Financial Management, a complimentary appointment, kind of see where you are. Call this number now, 866-668-3625. That'll grab an appointment for you. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. 866-668-3625. Grab them now. They will not last long. Next scenario, Casey, to you. I'm reading a lot about long-term care insurance, and I don't know if it's a good idea or not. So I'm asking if long-term care insurance is worth it, or should I put those funds in my personal investments, high yields? I'm 40, no kids. My husband and I have $355,000 saved for retirement. Any wisdom, insight? Thank you.
That's a great question. I love that question. I think we probably don't get asked about long-term care insurance enough. Wouldn't you say, Mark? We bring it up a lot.
Yep.
Right. We bring it up a lot, but I don't think we get asked about it enough. And it's something that just gets overlooked. It's not necessarily a fun topic and it's not exciting because we're not growing our investments and things of that nature. But long-term care insurance is something that really can save a retirement plan. Because if there's anything that's going to blow up somebody's plan, what is it, Mark?
That's it. It'll be the A-bomb that goes off inside your plan.
That's it, right? It's the cost of long-term care. I mean, it is massively expensive. Not too far from our old office, a facility there. Mark, you have a client that worked there, and what was full care there every month? Like $12,500?
Yep, almost $12,500 to $13,000 per just for 1 month.
So you're $150,000 a year essentially for that. Now that's full care, but ultimately that's just a drop in the bucket of an idea of what that cost looks like for long-term care. And so using long-term care insurance really can be a great tool. We've got to set it up the right way. And for those listening, most people are familiar with the long-term care of a few years ago, I guess, or years ago, we could say, where we pay into it. It's going to pay us some amount if we need long-term care, but if we never use it, that money's gone, right? We paid for an insurance that we never got to use.
Use it or lose it.
Yep, and that is a frustrating proposition, right? So from that perspective, I'm not a huge fan. But that is where asset-based plans come into play. This is where we start to look at different investment choices or long-term care choices. And this kind of reminds me of that video or that audio clip we played earlier of Michael Scott, that GPS kind of not being updated, right? And having an out-of-date map. That's the same thing here. If we're not updated on current long-term care options, we're not truly aware of what's open to us and what our possibilities are. So here's how it's different. Instead of paying into this policy, and if we don't use it, we lose it, what we could do is we can pay in, get leverage on our money. So let's say over the course of 10 years, we pay in $100,000 and maybe we can get $200,000-$300,000 or more of long-term care benefits. So we're getting leverage on our money. We put in $100,000 over a certain time frame and we're getting a benefit of around $300,000. But here's where it's very different. If we were to pass away without using that insurance, that money that we put in, the money that we paid in plus some level of growth, let's say we put in $100,000, maybe it's $110,000 or $120,000 that's in that account, that will be passed to our beneficiaries, whether that be our children or a charity, whatever it is, that money will continue on. So now we're not leaving the money to the insurance company. We're protecting ourselves and we're making sure that money is there for the future as well. So I really like the current long-term care options. In this scenario, we've got somebody who's 40 with no kids. I mean, that could be a great time to really look at this. You've saved some good money. But even if you're approaching retirement, you're 5 or 10 years away, maybe you're right at retirement's doorstep, it's still worth having that conversation to see if it's something you're eligible for. And it really just boils down to being a good custodian of the funds and making sure that we get the most bang for our buck and that our dollars are working for us.
Tell you folks, you go over these scenarios, you're going to have questions about your own situation. The opportunity to get on the calendar with Elevated Financial Management, it's happening right now. We have the 10 appointments. They are complimentary. If you save $250,000 or more towards your retirement, these strategies are going to work best for you. Casey, walk us through what's going to happen for these 10 callers.
Well, this is a written financial plan put together by our team of certified financial planners. That all sounds great. What does it really mean? What it really means is a conversation with Mark and I. We do not want to talk at you. We want to talk with you. We do not like to use terms that go over and above people's heads. Finance is complicated. We do our best to simplify it and have a real conversation about where you're currently at and where you'd like to be. So in that conversation, we're going to talk about your investments, how they're structured. Are they set up in the right way to provide income for you, to make you successful in retirement? We're going to talk about your taxes. What can we do to lessen your taxes overall? As we just discussed, we'll talk about long-term care. Does that have a place in your retirement? Are the funds there that we can purchase long-term care insurance and make sure that you're taken care of into the future? And ultimately, all that we can, all the things that come into retirement, we want to discuss that with you one-on-one, custom tailored for you so we can build that custom tailored plan. So don't hesitate, pick up the phone, give us a call.
So what you're telling me is you're not going to create a plan that will drive their retirement into a lake. Is that what you're telling me?
That's exactly right.
Yeah, you're going to make sure that roadmap is secure for your retirement. Again, here's the number to call to grab an appointment, 866-668-3625. Again, 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. 866-668-3625. Another edition of Elevate Your Wealth is in the books for Mark Stimson and Casey Elkins. I'm Morgan Patrick. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.